Market Day Report. So glad you're with us here this morning. Let's jump into the markets, and we'll start with corn as we take a look at the prices for our row crops. And the March contract is old crop for corn, so what's already in the bin, 486 3/4, up 4 3/4 cents, and well, 487 now as we're a nickel higher and at the top end of the trading range. New crop is December, so that we'll actually start planting that in South Texas. They'll plant the first crop of the season within the next few weeks. 460.5 on the December. It's 2 1/4 cents higher. What about soybeans? Well, beans have been lower, but now have turned higher. Old crop 1047.5. It's 2 1/2 higher. And over to the wheat market, we'll stick with the new crop contracts here. Chicago, the July contract at 566 1/4. It's up 4 3/4 cents. Hard red, July, new crop, 3 higher, 575 1/4. And spring wheat, December, 636.5. It's unchanged. New York, cotton, 69.42 on the December. Also the new crop there, and it's 7 points higher. Look who we have in the studio with us. It's Chris Swift. Chris is with Swift Trading, and when you look at the action we're watching right now in the row crops, really a reversal or a turnaround here on a Tuesday.
Well, it is. And think about last week when Argentina came in and said they were going to cut export taxes for them. It's really interesting. The grain market took a little bit of a dip, but not much. And here we back are flirting with $5 again for July corn. I think it's really important to look at the springtime of the year where we could get some real big fluctuations in the grain market, even if it doesn't last, just because delayed planting, maybe it's a little bit too dry, too wet, whatever the case may be, there's always that opportunity. So let's try to take advantage of that opportunity. And in all honesty, I think owning call options for a farmer that wants to make new crop sales out there, own call options at the strike price you would be willing to market grain at. And then if it happens to achieve there, market your cash grain and you're still long the market. Now, it doesn't do anything for protecting what the price is today, but we're kind of looking for a little bit better aspects than what we have today.
Sure, and just to highlight that there are plenty of marketing options to achieve whatever your goals are.
Absolutely there is. And we know South America is right in the midst of harvesting a huge crop right now. We still consider China in a recession. We believe that they may come out of that. They could produce stimulus at any given time, and that would be a really big boost to our grain markets.
All right, I want to switch over for just a moment and look at what we're seeing in the energy markets. And crude, kind of a rebound this morning, as high as 74.31 on the March, and we're still 80 cents off of that or so. Trading in positive territory. Gasoline futures, and gasoline really has been hit over the past year. Had a pretty strong month and is moving higher. And then nat gas, which had a huge previous 12 months, gaining 52%, but really has given back about 10% of those gains over the last month. Are you keeping an eye on these?
Oh, absolutely, because diesel fuel, it's backed off about 25 cents off of its high. So that made it very attractive to be buying again on it. Top off your farm tanks. Be proactive and own a little fuel for book it for this spring's time. Do things that are going to fix these adjustable or variable input costs that we know are going to be needed as we can move on into the future. So fix some of them when the prices are a little bit lower, and then worry about if they could have been lower later on.
All right, I think we can tie this in to our next segment, which is livestock and cash cattle sales from last week. How will we tie it all together? Hang on. You'll find out. Market Day Report continues after this. We're talking today with Chris Swift. We'll get Chris's insight in just a minute on tying diesel fuel prices over to the livestock market. Let's start with live cattle, though. Look at this chart. It's a 6-month chart for the April contract and just shows what we're talking about when we talk about record territory for live cattle. 6-month chart for April 25 feeders, pretty much the same story. Let's go over and look at actual prices now from the board. And that front month February at 206.75, we're, what is that, 37 cents off the day's high, but $1.07 higher on the session. April, 205.17, it's $1.35 higher. And then over to feeders as we look at those month by month. Front month at 280.05, that's up 32 cents. And 276.35 on the more active March, it's up 107. Hog trade, and again, I don't think there's anybody that's going to argue that hogs are moving higher, maybe on the coattails of what's happening with cattle. February up 60 at 83.65. Chris Swift's in the studio with us. Chris is with Swift Trading. Our conversation earlier was on diesel prices, and a pullback in prices allows you to go ahead and stock up some of those tanks. But what we saw last week, packers in Nebraska going south, buying cattle for less money, and then trucking them back to the north. Just a good example of making all of your inputs work to your advantage.
Oh, absolutely. And we clearly see that we have too much processing capabilities out there for the number of animals that we have, because it probably cost about the same amount to truck those animals as what they could have purchased them there, but they may not have been able to purchase them there. So they had to find inventory. And we see that more and more as we go around. Every single processor is having to really fight and bid hard to bring that inventory in. And we saw the same instance between 2009 and 2013, where we had greater packing capacity than we did number of animals. And the industry took a very bold move, and they bought out some of the poorer performing processors and mothballed them. And then that became a very lean processing machine. And that's what they're going to have to get back down to again, because I think during COVID, we spent so much money on trying to grow everything to meet a demand that was caused by the COVID trillions of dollars spent out, that we haven't been able to catch up on that supply chain yet.
Chris, I'm just wondering, and I'm not trying to get political here, but is this, now when we look in the rearview mirror, part of the danger when we approach government to fix problems in the livestock industry?
Well, in any industry. So we see, we talked about cocoa before and how high it is. And again, I think a lot of this was not supply disruptions as it was great demand for it that just outstripped supply. And we've never had that demand before because we haven't had $6 trillion thrown out all at once.
Right.
So,
and we see some of that back over in the energy markets, not enough supply for natural gas.
Yep.
Thus the 52% year-over-year increase.
Absolutely.
All right. Chris, always great to see you.
Oh, same here,
Will
sir.
you come back and see us soon?
I will, absolutely, next Tuesday.
All right. Chris Swift is with Swift Trading. And before we go, average home prices up more than expected in November. Fannie Mae and Freddie Mac are reporting year-over-year prices up 4.2%. The slowdown, though, is due to higher mortgage rates led by cooling demand. Increase the cost of borrowing, and suddenly we don't want to borrow.
I was going to say, when the prices are high, the demand, let's pump the brakes a little bit, right? Thank you, guys. And good to see you. I call him Professor Swift, and you'll be, of course, holding classes throughout the day. Thank you, Chris.